Welcome to the deep dive. Today we are heading into the really high-stakes world of small-cap investing.
It's a volatile one.
Absolutely. We've pulled together a lot of material quantitative analyses, fund manager playbooks, and our mission is to basically cut through all that noise for you. We're going to distill the rules, the risks, and the strategies you need to know.
That's the goal. We're providing a shortcut, really, because you have to understand the rules for small caps are they're fundamentally different from large cap investing.
Right.
If you walk in with an index fund mindset, you're going to be in for a surprise.
And some of the sources we have are, they're from managers aiming for returns we haven't seen in a generation. But let's start with the biggest shift the research points to,
Okay.
which is that the quality of the small cap universe has improved, and I'm quoting here, exponentially over the last decade.
This is the absolute foundation of the modern small cap story. It's so important. 10, maybe 15 years ago, a small cap was a company with, what, $100 million market cap?
Yeah, something like that.
Today, that definition has just ballooned. We're talking about companies consistently in the $1 to $2 billion range. And that kind of size, it just requires better systems.
So they're bigger, sure. But how does that directly translate to better corporate governance? What's the mechanism there?
It's the financing pipeline. It really is. Many of these companies now have serious institutional or private equity money in them before they even go public.
Okay. The pre-IPO stage.
Exactly. And a PE firm, by its very nature, demands a robust board, clean accounting, clear debt management. They force that discipline early on. That scrutiny has really reduced leverage. We're just seeing better debt-to-equity ratios across the whole sector.
Okay, so if the quality is getting structurally better, let's unpack this.
Okay.
What is the non-negotiable requirement for an investor who wants to get into this space?
Time. It's just time. The experts are so adamant about this. They say small cap investing is, and this is a quote, not very different from private equity investing.
And by that, they mean you're taking on a lot of different risks at once.
A ton. You've got liquidity risk, you have business risk, and of course macro risk all bundled together. The big flashing warning sign is this. Anyone looking for returns in less than 1 or 2 years, they should not come into the small cap space at all. You have to be thinking 3 to 5 years. That's the minimum.
Why is that time horizon so critical? Let's talk specifically about liquidity.
Because these stocks are just so illiquid. One big trade, a single fund buying or selling a position, can move the price 20, 30% in the short term. And you have to be mentally ready for that kind of volatility. It's just noise, not a signal about the business. Long term, the price will follow earnings. But short term, it can absolutely spook you if you're not prepared.
Which brings us to the big question.
Yeah.
Why even bother with all this risk and illiquidity when you have safer large caps?
The alpha,
Yeah.
the potential for massive alpha creation. I mean, historically, mid and small caps have always outperformed large caps in developing economies, especially during high growth phases. Think Japan from the 60s to the 90s. But more importantly, this is the space where empirically, active fund managers really earn their fees. They can generate huge outperformance here, which is, something you just don't see as much in large caps anymore.
And this is where it gets really compelling. The sources suggest a great small cap fund has the potential for, quote, massive returns over a 12 to 15-year period.
That potential is exactly what made Peter Lynch's Magellan Fund. For anyone else, that's the dream, right?
Right.
So shifting to today, let's look at what makes a winning active strategy now, starting with how the big institutions think.
Yeah, the fund managers in our sources, they have a very specific goal in mind. It's an absolute return goal.
Exactly. They are not trying to beat a benchmark by 1%. They are aiming for a stock to, and I'm quoting, double money in 3 to 4 years.
Which works out to what, a compound return of?
About 18 to 24% a year. And to get that, you need to do intense research. You're covering a huge universe, maybe 500 stocks, to find just a few that are worth buying.
That sounds incredibly selective. And it must demand a ton of discipline.
It does. And that discipline shows up in their cash levels. If a fund can't find stocks that meet that tough doubling criteria, they won't just buy something mediocre.
They'll just sit on cash.
They'll hold cash. One manager said they held cash as high as 12 or 13% because they just refused to compromise.
Okay, let's pivot a bit. For the individual learner out there, How do you find these hidden stories or these navigators of the future? The sources really hammered home the idea of promoter integrity.
It's the absolute most critical first step. You have to vet the people running the show. Look for transparency.
What are the green flags for that?
Things like a well-maintained investor relations section on their website. Do they hold frequent and, more importantly, long conference calls? That shows they're not hiding.
You mentioned some interesting examples of on-field research in the source material.
Yeah, this is the fun part. The ability to spot a trend early. One investor told a story about literally seeing a carpenter using a niche adhesive brand, Jody Resins, instead of the big market leader.
Huh, that's great.
It is. That kind of real-world clue, you combine that with finding a financial inflection point, like a company's profit jumping from, say, 5 core to 20 core, that's where you find the real multi-baggers.
But searching for that perfect stock, it can be paralyzing. What about red flags? Or when do you know it's time to sell?
One of the experts, Dr. Mishra, had a great analogy for this. He said, don't miss the white or green flag because you're busy trying to match all 36 traits. You have to accept some imperfections.
Okay, but you still need exit criteria.
Absolutely. A huge red flag is a sudden stop in communication. The company's stock is up 100, 200%, and then suddenly, no more conference calls, no investor presentations. That's a bad sign.
And what about on the way in?
Be very wary of a business that already has unsustainably high margins. That's just setting you up for the risk of, inevitable margin deterioration down the road. And this brings up a really important question. How do you even vet companies in these super volatile, fast-moving themes like renewables or EVs?
Right. And one of our sources, Naveen Gupta, had a fantastic framework for this. He splits them into 2 buckets.
Exactly. The first bucket is your sustainable wealth creators. These are the reliable ones.
The compounder.
Compounders. Established history, strong balance sheets, lots of free cash flow, consistent metrics like ROCE and ROE. A great example was Dynamic Cables. It returned 8 times your money in 8 years, and now it's pivoting into things like semiconductors and data centers.
And then there's the second bucket, which is a lot riskier but with huge potential rewards, the navigators of the future.
Yes. These are your high beta plays, total binary bets. You're betting on a futuristic trend or a special situation, like a demerger.
Or a big respected promoter taking a stake.
Right. The returns can be, as the source said, seriously outsized. Think about the value unlocked from the ITC demerger for its hotel business, or betting on a niche marketplace like SG Mart because it's backed by the APL Apollo Group.
Okay, we have covered a massive amount of opportunity. Now we have to talk about the caution. What does all this mean for your portfolio construction right now, with the market being so hot?
Asset allocation has to be dynamic. It can't be static. I mean, let's be realistic. A lot of small cap funds have delivered 20, 30% compounded returns recently. Caution is definitely warranted.
So what's a reasonable allocation?
Unless you truly have a 10-year horizon, you should probably keep your mid and small cap exposure under 20, maybe 25%.
And if you do have that long horizon,
Then maybe 50 or 60% could be acceptable, but you have to be ready to stomach some really extreme volatility along the way.
let's connect this to the bigger picture. There's this common argument that large caps are safer, and maybe even cheaper today. What did the data from the sources actually say about that?
The data really challenges that narrative. This was a breakthrough insight for me. If you look at the Nifty 50 multiples, they're heavily weighted down by financials, PSUs, and IT, so the overall number can be misleading.
You saying those sectors are dragging the average PE down?
Precisely. If you exclude those specific sectors from the Nifty 50, the median price-to-earnings multiple for the large caps that are left, it jumps to nearly 40 times earnings.
40 times. That's incredibly high. That implies investors are expecting huge growth to justify that price.
And that's the problem. The median PE for the small cap space is around a much more reasonable 28. So empirically, the growth part of the large cap index is way more expensive than the small cap universe.
And are those large caps even delivering the growth?
Many of them aren't. A lot of these high PE sectors in the Nifty 50 IT, FMCG, auto OEMs, they're struggling to even hit double-digit revenue growth. Their multiples just aren't justified. And that's why you see foreign institutional investors, the FIIs, actually increasing their ownership in small caps. They're hunting for genuine growth.
That completely reframes the market picture. We all assumed large caps were cheaper, but if you isolate the growth stocks, they're actually far more expensive. My final takeaway from this is pretty clear. This journey is long. It requires extreme patience. It's not about timing the market. It's about betting on management quality and catching those thematic tailwinds early.
And I'll leave you with one final provocative thought. Think about Warren Buffett's portfolio.
Okay.
With the exception of Apple, he almost never bought the number one best company. He bought Wells Fargo, not JP Morgan. He bought the second or third best. What made him successful was getting the price right. He always had a margin of safety. And that's the ultimate challenge for you as an active investor. It's not just finding quality growth. It's finding quality growth with a margin of safety built into the price.
Excellent advice to end on. Thank you for joining us on this deep dive. Now go forth and start looking for those qualitative flags and those critical inflection points in your own research.